I will like to focus your attention towards the second part of the statement of financial position. In the first video, we have learned about the format, the introduction part, and about the categorization of assets. So as I explained to you, there will be three elements of accounting in the statement of financial position, basically the assets, equity, and liabilities. So asset form we have finished discussing, but I will explain you the liquidity part, and then the equity and liabilities will be explained in this video. Okay, when we were discussing about the assets, basically the current assets, I told you the way that we are listing out the current assets elements will be according to the liquidity position. Let me clearly explain to you what this liquidity is. Liquidity is the ability to convert an asset to cash with minimum losses in a short period of time. Is the liquidity actually the ability of converting an asset to cash with minimum losses in a short period of time. So when you take stocks which has the zero liquidity position or very low liquidity position will be listed out first under current assets, then the trade debtors which has a little higher liquidity comparative to the stocks, then the income receivables, which is a new element to you, which I will be discussing in my next videos, and cash at bank and the cash at hand. So cash at hand means already cash. Their liquidity is 100%, and cash has 100% or very high liquidity position. So hereafter, when you are formatting the statement of financial position under current assets, when you list out the elements of current assets, you have to follow this liquidity method. Stocks comes first, mainly the closing stocks, then the trade debtors, then the income receivables means in simple terms, if I explain the incomes that we are going to be received in our next accounting period, and the cash at bank and cash at hand. You have to by heart this order. Okay, with that in mind, we'll move on to the other two elements, that is the equity. Okay, equity means the value of assets that belongs to the owners of the business. The value of assets that belongs to the owners. They are the people, the owners are the people who will be financing a business, and the total value of these assets will be known as equity. You have learned this in grade 10 as well. But here I want to focus your attention towards this again. Then once organizations use its assets to settle its external liabilities, the residual is called as equity. Once organizations use its assets to settle its external liabilities, the residual or the remainder will be known as equity. So let's see what this is. Assets are equal to equity plus liabilities. That is our formal accounting equation. The total assets that belongs to the owners will comprise of equity plus liabilities. Liabilities are the obligations that we have taken from outside parties of the business. So example, like loans, when a business is running short of financing or necessary amount of capital, they will borrow or obtain loans from financial institutions and other external parties. So that plus the equity will comprise of assets. So once these external liabilities are being settled by the business, we can build up this kind of a relationship, mathematical relationship like this. And our new equation will be equity equals assets minus liabilities from the total assets available in a business. Once you settle or once you take away the external liabilities, the remainder will be known as the equity. Equity. So this equity can be either increase or decrease. When you invest additional capital to the business, when you earn, if it's a already existing business, from the previous year's profits, the equity can be increased. Or if there are incomes also, it will lead to increase in equity. So there are three elements which will increase the equity of a business. And in the same way, there will be three ways of decreasing equity as well. Drawings, when the owner uses the business's cash or stocks for the personal use, it will be known as drawings. So thereby the equity or the ownership will decline. Or if it's a already continued business, if you have occurred losses in the previous accounting periods, that will also lead to a drop in the equity. And the expenses. All these three will also decrease in equity. So at the exam, sometimes for a 1 mark question, or in the MCQ, in the first part, as an MCQ question, you will be tested these two areas. What are the elements or mention two elements which will increase equity, or mention two elements which will decrease equity. Like that, you can be tested for 1 mark in the second paper or in the MCQ paper. Okay. Now, as I explained to you, the equity or the ownership of a business can be in cash form or in the form of non-current assets. Examples. Now, like owner can bring the money to the business or can finance the business by investing money, or if the owners have extra buildings, motor vehicles or machinery, such things can also be bringing to the business, and thereby the ownership can be increased. So you have to remember that not only the cash, by investing buildings, motor vehicles, machinery, any other non-current asset will also consist of or can be in the form of equity. Okay. Then here I have got an example. It says the accounting period starts on 1st January, let's consider it as 2019, 1st January 2019, and ends on 31st December 2019. Capital as at 1st January 2019 is 150,000 rupees. Assume that all these figures are in rupees. And the withdrawals, these withdrawals of cash worth of 12,000 and withdrawals of goods worth of 8,000 are there in the business during this accounting period. So simply these two withdrawals is known as drawings. This 12,000 which is in a form of cash, and this 8,000 which is in terms of goods or stocks of the business, both can be considered as one figure, and we will naming it, or we can be considered it as drawings by the owner. Then the net profit for the period will be 50,000 rupees. Okay, let's see how they are going to calculate the equity of the business as at 31st December 2019. So they have given the open equity and some transactions took place within the accounting period, which lapses 12 months. And thereby, they want us to calculate the equity as at end of the accounting period. So this is how you are going to calculate that. Always, the opening capital will be 150,000. The net profit, as we have discussed earlier, is always increasing the equity. Therefore, we are adding it to the existing capital or the opening capital, which is 50,000, and thereby the total equity will be 200,000. But during the period, they have been, or the owners have done withdrawals or drawings of 20,000, and that should be deducted from the 200,000 rupees of equity. Then at the end of the period, equity as at 31st December 2019 will be 200,000 minus 20, which will give you 180,000 rupees. So this is the actual equity at the end of the period. Then we'll move on to this activity given in your textbook. It says, on 1st January 2019, again, let's consider it as 2019, Sudhira started a retail business of kids wear by investing 240,000 rupees in cash. Further, he has invested 30,000 worth of furniture and 300,000 worth of his own buildings for the business. The business earned 360,000 rupees worth of income and incurred expenses of 210,000 rupees for the 6 month ended 30th June 2019. During this period, Sudhira has withdrawn 80,000 rupees in cash and 7,000 rupees worth of kids wear from the business. So when you were given a case like this, you must first identify what type of business is this. So mainly this is a retail business which manufactures kids wear. So then at the beginning, then you have to identify the accounting period clearly. Normally, we will be considered 12 months as an accounting period, but in case if they have mentioned that they are going to close the accounts after 6 months or 3 months or whatever it is, then we have to calculate a profit or loss accordingly. So here it says, at the beginning, he has invested 240,000 in form of cash, and further he has invested 300,000 worth of furniture, which is a non-current asset, and again another 300,000 worth of buildings. So at the beginning of the period, I mean at the end of 1st January 2019, Sudhira has invested, or Sudhira's capital will be this 240,000 worth of cash, this 30,000 worth of furniture, and this 300,000 worth of buildings. So during the accounting period, which is 6 months, ended in 30th June 2019, the business has earned 360,000 worth of income and expenses of 210,000. So thereby easily you can calculate the profit earned by Sudhira during the period, because always, as I explained to you earlier, incomes minus expenses will give you the profit or the loss. So here the incomes are 360, which is higher than the expenses. So you will end up, or the Sudhira will end up with a profit. Then the same period, Sudhira has withdrawn 18,000 in form of cash and 7,000 in terms of kids wear. That means the stocks of the business. So this 18,000 plus 7,000, 25,000 will give you the total drawings of the business, or the total withdrawals made within the period. So with this information, you will be able to find the equity of Sudhira at the end of the accounting period as at 30th June 2019. So once you do the workout, it will be like this. Calculation of equity as at 30th June 2019. Remember, Sudhira has made the accounts for a period of 6 months. So it's very, very important for you to identify what the business is and what the accounting period that they are going to consider. So as I told you, capital as 1st January 2019 will be the total of cash, furniture and the buildings, which will come to 570,000 rupees. And the net profit will be calculated by the difference of 360 from 210, which will be 150. So then the opening capital plus net profit will give you 720,000 worth of income, worth of equity for the period. And from that, when you deduct the withdrawals or less the withdrawals of 25,000 at the end of the period, which is known as 30th June, this is 6th actually, 2019, Sudhira will end up with an equity of 695,000 rupees. I hope you all have a very good understanding about this activity. So take your own time and go through the same activity again, work it out, and then see whether you have end up with an answer like this. So always when you are practicing the profit or loss or the statement of financial position, this is actually a part of statement of financial position, you better stick to this format. So then it will be helpful for you to proceed with your next lessons. Then I like to move on to this the third element, which is known as liabilities. So as you already know, liabilities means the obligations of a business that had arose as a result of a past transaction or events could be known as liability. So these are the payables of a business actually. So obligations of a business that had arose as a result of past transactions or events, which will derive future economic outflows. So that's how you have learned this in grade 10. So there are also at the exam, you can be tested again for 1 mark by asking you to mention the 3 features or 2 features of liabilities. So then you must know these are the obligations of a business which has been arose as a result of a past transaction and which will generate future economic outflows to the business. Okay. Again, as I mentioned you in my previous video, based on the time period or the time taken for repayment or settlement, liabilities are also 2 types. So liabilities will be 2 types as current liabilities and non-current liabilities. The examples will be creditors, trade creditors, and the expenses payable under current liabilities. And when it comes to non-current liabilities, bank loans and mortgage loans, which has an existence of more than 12 months or one accounting period, will be considered as non-current assets. Then, if I further explain this to you, current liabilities are the liabilities that should be settled within a short period of time. That means again within 12 months are known as current liabilities. Liabilities that should be settled within a short period of time of 12 months. So the value of liabilities which are changing within one accounting period is known as current liabilities. In your level, these are the current liabilities which we will be meeting when we are doing the sums. So trade creditors will be their expenses payable. That expenses we are supposed to pay towards the outside parties of the business. In next accounting period will be known as expense payable. We'll have a separate lesson for that. We'll discuss it there. So as an example, rent payable, interest payable, insurance payable, all these payables will be considered as current liabilities. Then when it comes to non-current liabilities, we can be define it as all the liabilities that cannot be considered as current liabilities. All the liabilities that cannot be considered as current liabilities are the non-current liabilities. So then, as I explained to you, bank loans more than 1 year and mortgage loans will be considered as non-current liabilities. Then I would like to focus your attention towards activity 8, even in your textbook, which is a good activity according to my point of view. Here it says, according to the accounting equation shown below, is the financial position of Sumudu's business as at 31st December 2019, let's say. So the accounting equation is always assets equals equity plus liability. So here also you have given the assets up to this point, then equity, then plus the liabilities. So buildings, machinery and furniture, which are known as non-current assets, are given at first. Then inventories, debtors and cash, which are known as current assets, are given secondly in the equation. As equity, they have given the capital value. And bank loans and creditors, bank loan will be the non-current liabilities. Creditors will be the current liability. So after that, they want you to show the above information in a statement of financial position. So it's very, very easy. First comes this is the format. So first comes the non-current assets. So you can list out the non-current assets there. Remember, when you are listing out, start with the immovable assets like land and building first, and then to movable assets. Then when you are listing out the current assets, remember to use the liquidity theory. So start with very low liquidity, which is the closing stocks of the business, and thereby little by little try to increase the liquidity position. Then you will get the total assets. Then equity and liabilities will be given. There use the opening capital or capital asset 1st January 2019. The opening capital will be dated like that. And for that, you have to get the net profit if they have given. In this sum, they have not given. So drawings also not given. So it's just a matter of listing out non-current assets and current assets. Then mention the capital amount, and then non-current liabilities, which are given as the bank loan, and current liabilities, which will be given as creditors. So you will be able to see when it comes to this format, always the total of non-current and current assets will comprise of the total assets, and that will be shown in the third column of the statement of financial position. Then you will be given the equity and liabilities. Then capital figure you have to get. Then list out the current liabilities and non-current liabilities. Get the total of them. Then these two values, the total value of assets of the business, must be equal to the equity and liabilities of the business. So thereby you will be able to equate the accounting equation. right? Otherwise, our accounting steps have been gone somewhere wrong. So always remember, if you have done the sum properly or the exercise properly, you must be able to get the value of total assets here equal to the value of equity and liabilities. Then I hope you all have got a good understanding about the statement of financial position, the introduction and the way of doing or way of preparing a statement of financial position. And I want you to stick to this format, which I have shown here. These are the main elements. Then in the next slide, the previous slide, I have given you the format of the profit or loss statement. And they are sales, cost of sales, gross profit, other incomes, expenses, 3 types. And finally, the net profit transferred to the capital account. These things you have to buy hard. When you are joining my next video, I will hope to complete one full sum with you. And I want you to have a proper understanding about these two formats and these headings, which I have been shown in my video. With that knowledge, I hope to meet you in my next video, and we will see how we are going to make a full profit or loss statement and the financial statement of financial position with the help of a given trial balance. Okay. Hope to see you in my next video. Thank you very much.